Good morning, everyone, and welcome to today's webinar. Today, we're going to be talking about an absolutely highly topical subject, which is the current health crisis, pandemic that we're all facing at the moment. It's still living through, and clearly this has had a massive impact on all markets and all countries throughout the world. But today, what we're going to be focusing on is one particular market segment, which is municipal bonds, and many of whom have where there's been a relatively unique impact on certain segments, certain sectors of that. And we've got two speakers today. I'll just quickly go through the agenda for you. First of all, welcome. My name is Ian Blance. I'm the Managing Director of Voltaire Advisors, and we're hosting the webinar today. We have JR Rieger, who I'm sure many of you will know, a highly experienced bond market commentator. JR is going to be talking a little bit about the bigger picture on the municipal market, what kind of things we've seen since this whole crisis kicked off. And then we get into the meat of the session today, which is looking specifically at a new product that's been launched, which is a ratings product for COVID-19 that measures the impact on municipal bonds, and that's going to be a presentation by Robert Kane, who's CEO of BondView, who are the company that's launched this product. And Robert's going to do a presentation, then a brief sort of product demo, if you like, to sort of go through, to show you online, the kind of stuff that kind of work that's being done there. So, there will be an audience Q&A, as there always is with our webinars. We've kind of factored in about 15 minutes or so towards the end of the session. The way, for those people who haven't used this webinar system before, you can submit questions, but obviously only by writing using the questions function in the platform. And what we're going to do here, to sort of, so we don't knock everybody off their stride, what I'd like to do is feel free to submit a question whenever you want during the session. We're gonna kind of hold them all until the end and deal with those in a moderated Q&A session at the end of today's agenda. So just again, submit your questions whenever you want. But we'll hold on to those questions and we'll deal with them all at the end. So we'll try and wrap up as close to 11 o'clock as we can. And apologies in advance if we don't manage to get through to your questions. We'll hang on to those and we'll try and answer them at a later date offline. So without further ado, I'd like to move over to JR Rieger. JR is the founder of the Rieger Report and is a well-respected and highly experienced commentator on all of the fixed income markets, I think, JR, but with a particular fondness for the municipal bond market. So JR, I'll hand over to you now if you'd like to take this forward.
Ian, thank you for that kind introduction. The muni markets is where I grew up, so it tends to be where I end up focusing quite a bit of my energy. So personally, as an investor, as well as a certified retirement counselor, when working with my clients and planning for retirement, bonds become an important tool in their toolkit. Not always the right tool, but it can be an important tool as individuals move toward retirement. So my views are of two different perspectives. One is as that certified retirement counselor and also as an individual investor. Now, my broker will attest that I have bought a few COVID-impacted bonds, but I've passed on quite a number of other bonds, and it's an interesting dynamic that we're in this world of both low yields and always searching for that higher yield opportunity, but at what risk? So and you can slide that forward a bit, we can talk about the markets and where we are today. So demand for munis still is relatively strong, and of course we've had that multi-year trend of low new issuance or supply. Then there are bumps in the road in regards to supply. Sometimes we get some nice surges or waves of supply, but relatively the bigger trend has been an imbalance of good demand versus not enough bonds to meet that demand. Part of that demand is driven by the current tax environment. Certainly, we're in a political year, so rising tax expectations are weighing heavily on investors, particularly those in California and New York. We've got some incremental yield for munis. When you look at the yield from the equation of a taxable equivalent yield, there has been equity market volatility, not downside volatility recently, but certainly when there is equity market downside volatility, munis begin to get more attention. We are in a low inflation environment, which is strong for bonds, but you know, are we all looking at the same inflation numbers the way we're supposed to is a big question mark I have when I look at bonds. And we also are in an environment where there's a strong dollar, which does contribute to the demand equation. And why bring up a strong dollar when we're talking about tax-exempt munis? Well, that strong dollar impacts the rest of the bond markets, whether we like it or not. Treasuries, corporates, mortgage backs, whatever. The competition that muni has is impacted by that strong dollar and potential demand for U.S. dollar fixed income. And when that drives those yields down, it can impact the municipal bond market, either as an alternative to those other asset classes, or as simply a yield choice relative to those asset classes. So just to summarize, demand is relatively consistent. Investor sentiment is key, though, in the municipal bond market. It's a need-driven sentiment from my perspective. Taxes are weigh heavily on many of the higher tax bracket individuals. And at this point in time, are there any other good options as opposed to munis? So all these add up to an environment that has been in place for a while and now is being impacted by COVID. So when we look at investment grade muni yields which are relatively cheap when compared to U.S. Treasury bond yields across the curve, I have to caution everybody that this is an extremely old school metric. It's probably really shouldn't be used by muni analysts or portfolio managers in and of itself, because I think that the risk-free market for U.S. Treasury markets are obviously distorted because Fed intervention. So looking at munis relative to U.S. Treasuries is something I caution my clients on in regard to what the yields are telling us. I'd rather compare munis to corporates as a more realistic comparison as to how munis are going. And looking at high yield munis and municipalities, I'm particularly worried about those municipalities that are dependent upon heavy tourism or tourism-driven economies. I believe they are elevated risk, and there are sectors within the high-yield marketplace that I particularly am worried about from the perspective of COVID sector-specific risk. I feel it's elevated, and we've begun to see defaults rise, particularly in some of these sectors. Some of the sectors I do worry about include senior care, nursing, CCRCs, dormitories for higher education itself, transportation, housing, stadiums, hotel occupancy, and sales tax, just heavily tourism based as well. So in the big scheme of things, when we're looking at municipalities or municipal bond debt, am I terribly worried about all municipal bonds? No, I'm worried about the cities that do have higher tourism dependency on their economies, as well as those particular sectors within the muni market that are dependent upon filling beds or filling units of housing, filling seats in stadiums, getting people into the museum, etc. All those types of bonds are what weighs heavily on me as an investor. But I'm looking at it from two perspectives. Is there a risk or is there a short-term opportunity to look at? So when I'm looking at each bond and I'm shown by the broker, I'm considering whether there's risk. Is it really long-term default risk, or are we in a cycle that's relatively short-term? And if it's a short-term cycle, can these bonds live through it? And as a result, I can potentially buy bonds at it with an incremental yield over the rest of the market. So I'm always looking at it from that perspective. And the answer always depends on the sector and the security provisions within the bonds themselves. And then there's that unknown Fed intervention that could happen in the future, and how it will unfold if it does, are all big uncertainties. And that does weigh in on what the risk could be for COVID impacted bonds. And if you can go forward one slide. Well, we're looking at municipal bond yields, investment grade and high yield. At the start of this year, well before COVID, the spread was 198 basis points between investment grade municipal bonds and high yield bonds. And the way this was calculated, I just took the yield to worst of two very large indices, the S&P Municipal Investment Grade Index and the S&P Municipal Bond High Yield Index, and just compared them over time. And we could see the March COVID impact as we go through the timeline. But currently, as I took the snapshot, the risk is widened between investment grade and high yield bonds by only 100 basis points since the beginning of the year. So is that COVID risk? If COVID risk is only 100 basis points, I tend to worry that the markets are not overall reflecting what the true risk is for a lot of these credits. If the incremental risk for COVID is measured by this very simple stat of only 100 basis points. So from that perspective, is risk on investing an appropriate term for the municipal bond market now? I'm not so sure. I think it's more blinders on in this market, where some high yield bond funds are getting cash. They have to put that cash to work. There's not a lot of high yield bonds to buy in the secondary market. So blinders on, holding their nose and buying bonds to generate the income necessary so that particular fund can compete versus the rest of the market. So again, I think it's not risk on. I think it's blinders on in some cases within the high yield market. Something that I do worry about. And again, my broker will attest that I've passed on more bonds than he showed me than I bought, because I do worry like a grandmother sometimes about the risks, unknown or known. And I think there's a lot of unknowns at this time. Now, just because we are impacted by this dynamic, the COVID dynamic, if you will, in some downturns, and there's not a lot of bonds being shown in the secondary market. In this case, there are some bonds that are indeed being shopped around in the secondary market and are trading, which helps us get a gauge on the value of those bonds in the secondary market. In a lot of cases, I still don't think the yield represents the risks. In some cases, I believe the yield does. And in those cases where I'm comfortable with the risk, I am able to pull the trigger and bring bonds in. But again, it's not all that frequently. The end of the story here, though, is I have a portfolio, and many of the advisors have clients with portfolios of municipal bonds. When we started the year, we kind of understood what our risk was, whether it be a credit risk, rising rate environment risk, liquidity risk. All these risks are part of the market. Then COVID hits, and now our risk profile for the muni market has significantly changed in my point of view. And it's time for muni portfolios to be reviewed from a risk tolerance perspective. Is that the same risk that I'm willing to take at the beginning of the year or not? And if it's not, perhaps some of the portfolios need to be recalibrated from the perspective of risk tolerance, because the risks have risen dramatically for certain sectors, as we mentioned earlier. And if you own those sectors and that's not part of your risk tolerance to own those sectors now, it may be time to make a shift out with that. So those are my comments, Ian. I hope it sets the stage for you for the next part of the conversation.
Thanks, JR. Yeah, that's very interesting. I mean, the idea, I think the notion here of the potential to review and maybe reset your portfolios in light of the new risk position, I think is something that is probably one of those features that's going to come out with in Robert's presentation, because from my perspective, we're still working this whole process through. There's still a sort of an uncertainty, if you like, that folks are not that folks haven't really yet managed to kind of reset how things are going to all work out, and there are lots of different tools that are probably relevant to this, but certainly some kind of assessment of how your bond is actually going to be impacted by COVID is one of those features that needs to be taken into account. So anyway,
Ian, I believe there's a lot of information available. It's how do you collect and interpret and understand all this information that is coming out about the impact of COVID on the myriad of municipal issuers. And it's a real challenge if you're not doing it all day long, and understand where to look in prospectuses and in disclosures. It could be a massive hurdle. So portfolio surveillance in this world of COVID is definitely going to be a challenge.
Great, thank you, Robert. So I'm going to hand over to you. I'm going to give you the presenter. So and once you'll be able to from here. Let me just do this now. There you go. So now you should be able to switch over to your screen.
Okay. Yeah, I think I just clicked the button, and thanks. Thanks, Ian. And JR, thank you for that great presentation. For those of you that were listening closely, I think you can hear the birds chirping in the background. JR is, I think, at a country home someplace, enjoying life.
Full disclosure from JR, he's actually at the beach. So
we're all someplace during this crisis. Anyway, thanks again. So I'm Robert Kane, CEO of BondView, and today we're going to be discussing two things. Will your municipal bonds survive COVID? And then also BondView released our COVID impact ratings for muni bonds this week on Tuesday. So we're going to discuss both of those things. A quick note about BondView. If you know bonds, then you probably know BondView. We've been in business 10 years. We generate pricing on all muni bonds on a daily basis. We do FDC's liquidity assessment for muni bond funds, 2,400 muni bond funds. We do that daily as well. And we also have the first BondView 500 index, which is the first liquidity-based index that looks at active trades and widely held bonds by funds. And that index is being picked up by a few companies as of recently. So here's a key question: is will our municipal bonds survive COVID? And this question is driven by the fact that rating agencies in the time of COVID are really getting overwhelmed. I mean, the rating agencies were kind of overwhelmed to begin with, just to keep up with the normal times, and in times of COVID, they just can't keep up. And accordingly, we were finding that ratings were stale in many cases, and still are stale. There's been kind of like a blanket attempt to take an entire sector and say, hey, S&P or Moody's will downgrade an entire sector like nursing homes or stadiums, convention centers, that kind of thing that they think are to be impacted. But there's really been there's been a lot less deep dive and looking closely. And also the muni market it's difficult to check the market's pulse because most munis don't trade. Less than 1% of any of munis trade on a daily basis. So our approach was, the question is, how do you test if a bond is potentially infected? And we have a 5-pronged approach, and we also are using a 1 to 5-star rating system where 5 is the worst. Think of them as red stars, and 1 is the best. And we have this approach where we're looking at 2 proprietary BondView measures, which are our liquidity rating and our market implied rating. And then 3 other areas, which would be a very close review of all material events and disclosures for each bond we're assessing, the sector of issuance that the bond is in, and then the geography. So together, we analyze, using this methodology, all approximately 1.4 million municipal bonds, and we do that on a daily basis. So what JR was talking about before is there's a lot of COVID-related information flying, through the air. Flying through the media, and it's hard to. It's like drinking from a fire hose to kind of digest it all. So we have this approach where we're able to analyze and rate all bonds. So our ratings were released on August 18th, this past Tuesday. They help investors and financial professionals assess the economic impact of munis to the potential impact of COVID. This acts as an early warning indicator. We do assess all munis that are out there. So you can look at one bond, you can examine your whole portfolio based upon each bond's market-weighted COVID rating, or you could look at funds. And by the way, we do BondView enables users to search for bond, create a portfolio. We also track all 2,400 muni bond funds, so you can actually deep dive into a fund, and I can show you one of those in a minute. And then our ratings are updated daily. Last but not least is that the ratings are free during the COVID crisis. So they're available. You can just go to this link, sign up, and you get access to them. So we want to see if we can do our part to help people out in the world and muni investors, and not ding them for offering information and making it available free, which is kind of part of our operating mode. We do have a lot of information that's available free on our site, and of course, there's plenty that's paid for. So we're gonna let's jump in and do a demo. The first thing I wanted to get to is this is a New York Times article from a couple of months back. It has to do with the genesis of how we got into the COVID impact ratings. So this article is about the plunge in convention hotel travel, putting muni bonds at risk. And it references a couple of convention center attached hotels. Like there's one in Austin, there's a bunch of them actually, but there are a couple that were just being built. Some of them were just finished, like this Hyatt Regency in Portland. This one was, I think was finished in December. and they kind of opened for business around February, and then, you know, basically there's no business happening because there's nobody traveling, there's nobody going to convention centers, there's nobody staying at hotels. So this sector, this convention center hotel sector, was what it was kind of what would, like I said, is kind of the genesis, because not only is this these projects are backed by municipal bonds, they're industrial development bonds, so there's a, you know, a private and public aspect to them, but they have like a real hard asset associated with this bond. So with these bonds. So for instance, if this bond were to go under or defaulted or bank, or let's say defaulted, and actually several of them have, I'll show you that in a sec, there's an asset tied to it. So what that means to us is that there's a group of COVID opportunity bonds. You know, there's another group of bonds that are COVID impacted, you know, probably really long term and may have trouble digging out of their problems. But there are also others that either are worth owning because they will bounce back, or because the asset and the underlying asset, like a new Hyatt or a new Hilton hotel, is something that the bondholders could get to own eventually in a workout. So that's how we got to kind of like how we got to, you know, the genesis of these COVID impact ratings. So this is, we're on our BondView website right now. So, and I'm gonna pull up, this is one of these, this is a Franklin County, Ohio convention center bond. So I'm looking, this is the name of the bond here. There's an attached, I think it's a Hilton, I'm literally physically attached to it. It's a fairly new project. So we've got information about the bond. You can scroll down the page and there's lots of data here. Two things you'd note is, one is that their rating for this COVID rating is 5 red stars, which, as I mentioned, is the worst of our 1 to 5 star rating. 1 is good, 5 is highly risky. The bond is priced at 99.40, and it's a 5% coupon. Typically, 5% bonds are not trading at 99.40. They're, you know, trading more like 20, 30% higher. And over here is our BondView implied rating, or market implied rating, which is 2 stars, which also indicates basically that bonds or similar bonds are trading at higher levels, or have yields at higher levels. Actually, trading at higher levels, but their yields, this bond has a higher yield compared to similar bonds. Anyway, so clicking this button here, how is this calculated? Let's jump in to see how we got here. So here's the COVID rating on this bond. So we've looked at our BondView market rating, and in this case it's a 2-star rating. This bond is not rated by the credit rating agencies, but we do have, this is a curated view of the rating agencies of a particular bond. Our BondView liquidity rating, which is is the bond liquid or not, is a 2-star rating. When we're giving that a vulnerable score. When we drill down into the disclosure, I mean, here you can actually see what's going on is that in June, they basically drew down unscheduled on their reserves, which is a technical default. It's not a monetary default, but it's a technical default. And, you know, there are other issues, like they modified their loan agreement. And then the sector analysis is that they are in this is a high risk area. Definitely a convention center hotel is probably, you know, one of the highest risk areas that we track. And then geography is that the bond is in Ohio, and Ohio is one of many states that have the number of COVID cases are above the minimum that we're tracking, which is about 25,000. So, you know, most of the states, about 3/4 of the states in the U.S. have cases that high. So this is one bond that, even though it has a 5-star COVID rating, which is a bad, you know, it's a highly risky COVID rating in our opinion, the fact that it has an asset, and we've done a little background research on this, the there's real, this hotel and this convention center are newly built. They're in the hundreds of millions of dollars in terms of what they're worth. And so this is a bond that's probably, well, let me say this is a bond that's worth owning in our opinion. So, we can also, if we go back to this page, we can click here, you can actually see the funds that do own this bond. So these are the municipal bond funds. There's a Goldman Fund, Vanguard, SEI, and a Delaware. That some of these funds are pretty large. Like the Vanguard fund is a $70 billion fund. The Goldman is a $7 billion fund, and they have small positions, but they own it for a reason. You'd probably have to ask them why. We also track funds that buy bonds as well as sell bonds. So you can see who's there are some funds that have started to buy this particular bond. Now I want to contrast that with this bond. This is a Nassau County senior assisted living center. Actually, this place, which is called the Amsterdam, happens to be 20 minutes from where I live. I had looked at it for my parents about a year or so ago. And they basically defaulted, and their bonds are trading at, in this case, $1. So they're also rated a 5-star high, bad COVID rating. And as to, if we take a closer look as to why, well, our own internal ratings are not good on this bond. They have a 1-star rating, which is our lowest. Again, this happens to be a bond that's not rated by the credit rating agencies, which makes it more nebulous for people to kind of figure out. It doesn't trade often, as low liquidity. If we look at its disclosure, they basically have monetarily defaulted on their interest payments going back to last year, and they're having other trouble. If we looked at it a little more deeply, they have trouble with some of their the number of residents or patients that are there are decreasing. The sector it's medium to high risk in that it's a assisted living facility. It's in New York State. So anyway, you wrap this all up, and it turns out that while this is also happens to be a newly built, last 5 years, actually very nice facility. It's almost like a canyon ranch, or it's like a nice hotel. However, there's a mortgage in place on this bond that would make it such that the bondholders are not first in line, and they would not get access to the asset. And that's why, in our opinion, this bond is probably something you would not want to own, because of those reasons. So that's a kind of a deep dive assessment of what this COVID impact rating enables you to do, is you can identify the COVID impact on 1.3 million municipal bonds. You can look at one bond, you can review your portfolio. You can look at, like here's a Goldman fund. This is the Goldman Sachs Dynamic Municipal Income A fund. It's an $8 billion fund. In general, we've assigned this a pretty good COVID impact rating. As a low COVID impact rating, 2 red stars out of 5. So on average, their market weighted COVID rating is low. If we look at the actual holdings in the fund, and I'm going to drill down a little bit here and sort by the COVID rating, there actually are, I don't know, about 40 or 50 bonds that have 5-star COVID ratings and 1-star market rating. So basically, these are, some of them, if we look to see what they are, actually turns out that that Franklin County, Ohio Convention Center Hotel that we talked about initially, they own several positions in that. And that's probably a smart holding on their part. There are other things like Puerto Rico bonds, which are, being hurt for other reasons, including COVID. And then there's, hospitals. And anyway, so you can drill down to a fund. You can analyze a portfolio this way. Let me see. I just wanted to show you something else. So this is a view, excuse me, this is a view of all the muni bonds that we are rating, the 1.3 million or so. And you can see here that about 2,900 of them have 5-star ratings, which is, that's the worst rating we hold. About 17,000 have 4-star ratings, and then, and then 956,000 have 1-star ratings. And then so what we're doing here is we're looking at all the bonds that are 4 and 5-star rated, 4 to 5-star rated, and then we're searching on terms like, that we know about, like sector related kind of things that are like convention center, right? So, when I talked about earlier, we want to generate a list of the top 10 COVID opportunity bonds by sector. That's where we're creating that from, and that's going to be out in the next couple of weeks. So basically, these are all the convention centers in the U.S. that have COVID ratings that are high, and on this list. So this is San Antonio COVID Convention Center, Franklin County we've already looked at, Las Vegas. Some of them repeat. There's Austin, Phoenix. There's lots of convention centers, and you can type in also hotel, and in this case we get a list of 167 bonds related to hotels that also have risky COVID ratings, like basically a lot of these bonds a lot of the bonds that are tied to these hotels, the hotels generate sales and use tax that goes back to pay back the bonds. If no one's staying at the hotels, there's nobody, the money's not coming in, and it's likely some of these are going to be defaulting if they haven't already. So anyway, that's the kind of a quick overview. I want to hand it back to Ian and JR and see if you guys wanted to comment or have any feedback so far.
Yeah, thanks, Robert. Yeah, really interesting. I think it kind of goes a little bit back to what JR was saying earlier, where you have yeah. By the way, Robert, I'm going to leave you up at the moment just in case you need to kind of use your screen to answer any questions that are coming. Right, so I won't switch back over just yet. So yeah, it kind of goes from my perspective. JR talked a little bit about this huge kind of flow of information that needs to be digested to be able to come up with any to come up with some reasonable conclusions about the muni bonds, either the ones you own today or even the ones that you're planning to buy. And this seems to be a pretty good way of kind of filtering a little bit about that. So I've got some specific questions here, but before I do that, JR, have you got any comments that you want to make on this?
I just want to ask Robert if someone were to show me the city of Chicago GEOs or New Orleans municipal bonds, can I use this tool to look at what the COVID risk might be?
Yes, you can. Yeah, so you can use this tool to look at like any bond. And all right, New Orleans, I think has some issues with the ports, right? I mean, it's a big port city, and if things are not coming in and out, maybe the tax revenue is slowing down. But yes, every bond is that in every muni bond is rated. So yeah, good question.
So that kind of one of the questions I had, one of the questions that came up actually, Robert, was that you talked in your examples that you used here. You talked a little bit about almost like kind of trading opportunities. Are there bonds out there which maybe are being hit by COVID, with maybe have got something backing them, and the reverse as well. I think you used the Nassau County one to illustrate that there's a mortgage on the property and all that kind of stuff. So can you foresee any kind of other use cases that might kind of crop up with this? Are there any other, in addition to kind of trading?
Yeah, well, The obvious ones are the convention centers and hotels, and then you can, if you look in the travel and leisure sector, stadiums. So like Yankee Stadium. I mean, I'm in New York, so Yankee Stadium and Citi Field. There's nobody going to those places anymore, at least for now. There are parking garages tied to those entities. Both, and those were built with municipal bonds. They're, industrial development or private activity related bonds. And so, that category, industrial development and private activity bonds, are things that are, not purely public sector beneficiaries, if you will. There's a crossover, so they typically have assets tied to them that are probably more attachable, if you will. I think like a nursing home. I think JR and I discussed is it's unlikely that the underlying nursing home would ever be anything but a nursing home. It's not going to be somehow extracted out as an asset. It would be this kind of an awful thing to even think about. But so those are probably off the table. And in travel and leisure related entities, restaurants, convention centers, that we keep discovering these different kind of like subsectors that are out there.
Yeah. Can you talk a little bit more then about the kind of the 5 factors that went into this process? Because you kind of mentioned those, I think, in your presentation, right? But
Right.
I think it would be useful just to kind of have a good sense of, which ones go into it and how you guys treat it.
Yeah, so I'm looking at my screen now, the press release that we issued the other day, and this is going to succinctly. There's also a little video. Anybody interested in viewing? But basically, the 5 factors are for each municipal bond. We look at their sector, all the material events, the geography, the marketplace perspective, which is our market implied rating, and the bond's liquidity. Now, regarding the material events, bonds have these days, lots of financial disclosures. Some bonds could have, 20, 30, hundreds even. And so we're reviewing all of those programmatically using some artificial intelligence to identify the material events that are, related, or I guess you'd say that are negative, have negative connotations, like downgrades, defaults, changing in loan terms, things like that. So we're able to, that's how we're able to hit 1.3 million bonds, is using this automated, intelligent platform, if you will.
And just to reference a little bit that kind of material events and bond specific events. A question here for JR actually. JR, you referenced in your presentation at the beginning that you felt that the whole kind of COVID risk hadn't been fully factored in, and that investors had their blinders on, and that they were that was something that hadn't been properly addressed at the moment. Is the way you're thinking about it? Do you anticipate that there's going to be some kind of downstream impact on this? Is this going to kind of flush out a bit more in your view?
Ian, what I was referring to was the spread differential since the beginning of the year to today, and when we look at that, we take all other risks off the table, and certainly there are other risks like political risks impacting the muni market. But if that was just COVID, that would represent what I would say is a modest yield differential relative to the unknown risks that COVID is presenting. And I think that part of that isn't just investors putting blinders on, it's the dynamics of the muni market. While there is a need for tax exempt paper and a need for yield, there isn't a lot of other choices, and that becomes part of that dynamic. Now, ratings agencies and other firms have done a tremendous job of putting a lot of information out there. I think we've seen, you know, the larger ratings agencies do weekly updates of the marketplace and sectors. Again, that's a lot of information. It's drinking from a fire hose, as Robert mentioned. So there's all these potential risks that I see out there. And yeah, I've been called half glass half empty, and glass half full at different times in my work life. But at this point in time, there's two things that I'm looking for. Is the bond impacted by COVID, and at this current yield, an opportunity to add to my portfolio, or is it at a point in time where the risk is not really being reflected in the yield and I should pass on it?
Yeah, and I'd like, if I can add to that, JR, a good point. So if you're a fund, and like I'm showing my screen here, this is a Goldman fund, and not picking on Goldman in any way. I'm an alumnus of Goldman, but if you have a fund, in this case, they've got 2,800 bonds or positions in their fund, it becomes difficult to monitor on a daily basis this new notion of COVID. I mean, it's not entirely new, but there are not many tools out there for assessing risk for COVID across an entire fund or portfolio. So this seems to us to be an easy way to get a sense of which bonds in your fund have 5-star, 4-star COVID ratings that you should be maybe taking a closer look at. Chances are any good fund manager is probably aware of everything in their fund and why they're holding it. That said, there's a lot of information that's out there. Things are changing pretty rapidly, so this is just a good tool to. It's an early warning indicator, especially for folks with large portfolios or funds.
So your kind of view on that, Robert, is that it's a way of kind of filtering and holdings to kind of give you a sense of which ones to focus on to begin with. So like you got hundreds of bonds, you got to start somewhere, right? So when you come to look at those from a tracking perspective, so
right. Some of the larger funds have literally 10,000 muni bonds in their fund. I mean, how do you it's not a job meant for a human to monitor COVID risk in a fund. You can't look at 10,000 bonds on a daily basis. So
yeah.
But you can't use a tool like ratings to do that for you.
Yeah, JR mentioned as well that about the ratings agencies. I think it's certainly been a view of mine for some time that the ratings kind of tend to lag the marketplace a wee bit. So you kind of get they eventually come up with the right with a view, but if something happens in a bond, the market tends to react more quickly. So, and you mentioned, I think at the beginning, that this was a market-driven tool as opposed to a kind of fundamental research-driven tool. So do you see this as being like some kind of, as you mentioned, an early warning indicator,
Yes, yeah, that's a good point. BondView as a whole, as a tool, is market-driven. We don't have generally S&P or we don't have credit rating agencies data on BondView, and that was done purposely because we are really a market-driven product. Tool in that we're always checking the pulse of the market, and we have this, this market implied rating is basically this is kind of a unique tool in that we're rating bonds based upon where they trade relative to similar bonds and where those bonds trade. And that's really helpful to identify. It is an early warning system in itself when bonds start trading lower, the market ratings go lower. especially, you know, in a portfolio of 100 or 1,000 bonds, you may not be able to pay attention to that. So yeah, tied into the whole COVID case is that, you know, there are many disclosures, municipal bond issuers that are filing disclosures about their status, and there's, you know, literally tens of thousands of these things that are out there so far, and they keep coming fast and furiously. So, you know, how does anybody? It's a difficult job for a human to do. Let's just put it at that.
Yeah, and I guess the other thing to bear in mind as well is that you know, as you know, my kind of assessment of this is going to take some time, right? You know, the whole COVID impact will work its way through. It wouldn't have been instantaneous. There would have been an immediate reaction, and I guess folks have been spending some time working out which bonds, you know, which sectors are most likely to be impacted, and trawling through disclosure material to see which ones have already either technically defaulted or whatever. But I think, you know, one of the things that seems obvious is that, you know, as the process goes on, and as income is increasingly affected, and revenues dry up, then, you know, this impact will feed through progressively into the muni sector, right?
Yes. No, I think we're unfortunately starting to see some of that already. You know, in the sales tax revenues are down tremendously. Like I said, I'm in New York. Outside, I live on Long Island, but I was in New York City in Manhattan last week, and it's a little darker and dirtier than I remember. And you know, crime is up, taxes are, people are leaving the city and moving out to some degree. Anyway, you know, income tax is going to be lower because people are no longer there. Sales taxes are going to be lower because there are less people buying things. You know, things that, you know, the purchasing regions have kind of like shifted. But yeah, and then I'm starting to see even, you know, word of layoffs in public entities, like some teachers are getting laid off in some cases, some schools, etc. Back to you, Ian. Any questions on that list from the audience?
There are a couple of questions relating to the product itself, and you know, we've got kind of like a few minutes left. I'd like to try to cover those if I can, Robert. Which is that you know, there's one question. It's can you sort all of the muni bonds according to their COVID impact rating? You know, using this tool.
Yes. So you can, it's a big list, right? It's 1.4 million bonds, but yeah, you can sort, I mean, you could sort them or filter them out by various criteria, you know, like by rating, by sector, by, you know, you name it. We've made it so that it's very easy to cut the data and come up with a list to the point that, you know, we're going to be generating, you know, these top 10 COVID opportunity bonds by sector. As I mentioned.
Will that be on a daily basis, the top 10?
I think so. I mean, yes, I guess it would be, because these ratings are all done daily. That's another important, you know, big heavy lift that we're doing, is that this is all literally reassessed on a daily basis.
Okay, yeah. Because you showed a chart with, I think, the number of bonds that were in each one of the COVID categories. Is there any chance you can pull that up again? I can't remember where you. I think you showed one. It was like 2,900.
Yeah, here we go.
That's the one. Yeah. So I think the question was, you know, if somebody wanted to kind of look at those 2,916 bonds that were rated 5, that's the lowest rating, right? 5. So right, that's the biggest impacted bonds, right? So is there some way that somebody could actually sort of download those at this stage?
Could you download those? Well, as a BondView Pro subscriber, which it's only $99 a month to be a subscriber, you'd have access to all the COVID ratings. So yeah, you could, if you wanted to download those.
You could screen for those on a regular basis, just to make sure that you've got you're covering all of the ones that, according to BondView, are the biggest impact, right? So.
Right, and the data changes daily, as I mentioned. So there's you could get today's version of it, but that may be different a week from now.
Yeah, because if I'm looking at that, I'm going to want to, I'm going to want to know whether any of those 2,900 bonds are in my portfolio, right? That's the first kind of urgent, piece of work that I kind of want to be doing, So
right, you can do that. We're also going to have an API feed that would be available that has the whole repository if somebody wants it, or access to portions of it, like just to programmatically do that. Also, if you have a portfolio, you can load it up to BondView, and Bond can analyze it in our portfolio analytics section that includes the rating. Either way.
That was actually my next question. That was the one. Was that, is there some kind of portfolio function, portfolio monitoring function? Can you show us that a little bit if you?
Yeah. Let's see. It's over here. Take a second to load. I think I actually had some. Oh, here we go. Austin, Texas. So this is our portfolio. This Austin Convention Enterprise is basically it's a convention center, also newly built in Austin, that similar to the other ones I talked about. So here's the COVID rating at the end of this portfolio. Basically, we created a portfolio of the whole series of bonds in this particular issue. We're all rated 5-star, poor, bad ratings, if you will. So yeah, that would be a way for someone to, you can look at a portfolio. We've given this portfolio gets an F on its report card rather than an A. There's different ways to look at these portfolios, the portfolio assessment.
All right.
Yeah.
Oh, yeah, cool. Yeah. Great. Okay. Yeah. Well, we're running a wee bit out of time, so Robert, I'm gonna pull back to me just to kind of sum up, if that's okay with you.
Please do.
Let me just give myself the screen back. Here we go. All right. So, well, we've kind of we're kind of running out of time. I think I said at the beginning that we would deal with any other questions that crop up offline, if we run out of time to do all of those. So we'll try and make sure that we cover as many of those as we can. And just a final kind of bit of housekeeping really is that first of all, thank you all for attending today, and thank you to both JR and Robert for presenting. I think an extremely topical and very very interesting and challenging environment in which we kind of we operate in, and any tools that are able to allow us to kind of get our job done a bit easier than we can at the moment is welcome, I think. So so thank you all. Thanks to JR, thanks to Robert, and finally, the biggest question that we get asked most of all is, will we get a copy of the slides and a copy of the recording? And the answer to that is yes. We'll be doing that, and likely by the time we've loaded all that kind of stuff up, we'll make sure that you get a copy of everything that was talked about today, emailed out to you for everybody that registered. So yes. So thank you again. We'll wrap things up here, and we'll be in touch with all of the supporting materials in due course. Hopefully see you all again next time on one of our presentations. So thanks, Robert. Thanks, JR, and we'll wrap up now.
Bye.
Bye, everyone.